Walk into any corporate boardroom right now, and you will feel a tide of money and anxiety washing over every decision. Executives treat artificial intelligence as the inevitable operating system for human civilization. In these rooms, the greatest risk isn't technical failure, it's the fear of being left behind. The world's largest technology companies have framed this transition as a mandatory shift in the order of history. From massive keynote stages, they broadcast a single message: adopt now or become obsolete. This engineered urgency triggered a frantic rush of capital. Investors and boards are moving first and asking questions about the balance sheet later, desperate to buy their way into a future that hasn't been priced yet. In this environment, belief has become the primary asset. The market rewards the sheer scale of a company's ambition, often overlooking the fact that the underlying business model remains a mystery. But software is supposed to be weightless. AI is not. It lives in cold, glowing rows of server racks inside massive warehouses. It requires heavy industrial machinery to exist at all. To build out this physical footprint, the industry is committing hundreds of billions of dollars. They are buying land, pouring concrete, and securing supply chains at a scale that technology markets usually only see after a product has matured. That leads to a difficult question. What happens if this trillion-dollar physical infrastructure is being built to support a software business that has yet to prove it can generate a profit? To see the disconnect, look at the industry as a vertical technology stack. The bottom is the infrastructure layer. Every prompt requires immense computation, driving a constant, expensive demand for specialized silicon, servers, and liquid cooling systems to keep the metal from melting. Because this hardware is so difficult to manufacture, the companies designing the chips have become the toll collectors of the boom, extracting massive premiums. And chips are only the initial cost. Running them requires a staggering draw on the electrical grid. Tech giants are signing multi-decade power contracts. The market often interprets this massive infrastructure spending as proof of commercial success. But these aren't sales. They are a colossal financial debt that must eventually be recovered by selling software. Moving up the stack, we find the mechanism used to justify that debt. This is the model layer. To keep investors comfortable with the infrastructure bills, executives rely on highly controlled stage demonstrations. They show a machine that appears to think and reason instantly, promising a total corporate transformation. Startups and research labs use this feeling of inevitability to raise billions. Presenting their work as a historical shift, they attract capital while avoiding deep scrutiny. When analysts point out the cash burn, the response is a promise that the next version of the model will be so advanced it will autonomously replace human labor, fixing the economics later. This middle layer runs on expectation. It produces a vision of future dominance that justifies the staggering bills piling up in the data centers below. But eventually, the models meet real customers at the tiny applications layer. Here, the magic wears off. Systems hallucinate. Vulnerabilities appear. Compliance teams block deployments because outputs cannot be legally verified or explained. Companies are discovering a hidden labor cost. Tools sold as automated magic often require extensive human babysitting, employees spending hours writing prompts and manually correcting the machine's errors. That friction kills momentum. Enthusiastic pilots run their course, and when it comes time to renew expensive long-term contracts, procurement teams look at the limited productivity gains and walk away. The narrow, fragile top layer of revenue is failing to keep pace. It cannot possibly subsidize the trillion-dollar infrastructure bill waiting at the bottom. You rarely hear a pop. Instead, the market simply hesitates. Investors look at the stalling contracts and the soaring compute costs, and they stop asking what is possible. They start asking who pays. The fallout is immediate. Capital dries up, startups stretch their runways, and the grand corporate language abruptly shrinks. No one talks about reinventing civilization anymore. They talk about optimizing email drafts. For companies that used growth narratives to mask weak economics, the environment turns hostile. Customers demand audits. Regulators issue subpoenas. The market trades breathless reviews for liability reports. The era leaves us with a very old lesson. Technological utility does not automatically create a defensible business model. A machine can be genuinely impressive and still be a terrible investment. The capability is real, and it will survive the crash, But the speculative financial structure built on top of it, the companies that price themselves for perfection, will be wiped clean. The economy doesn't break because the technology arrived. It breaks because everyone spent as if the profits had already cleared the bank.